recorded version of today's class, you can do so by using the same link you used to come to this class. And in about 24 hours, you can watch the recorded version. Or when investing.com has had time to clean it up and edit it, you'll be able to find it on the investing.com website under the Education tab and then Webinars on Demand. And in fact, there you can see any webinar we've ever produced and watch them at your convenience. All right, ladies and gentlemen, so let's get on discussing displaced moving averages, one of the most unique applications of an old indicator. Now, in today's class, I'm going to use the term security when referring to any tradable financial instrument. This includes stocks, bonds, commodities, futures, indices, mutual funds, options, and even cryptocurrency. Now, I might say Bitcoin, I might say the euro, I might say Facebook, I might say Apple, but I'm talking about all publicly traded financial instruments in an open market. Similarly, I intermix the terms investing and trading. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. But it gets very, very boring just saying trading, 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 or investing, investing, investing. So I mix and match them, but you know what we're talking about. Now, whenever I do a webinar, when I do a seminar, when I do a live presentation, when I'm meeting traders one-on-one, when I'm doing live and private classes, the first thing people tend to ask me is, what should I buy today? What should I sell? What will the prices be tomorrow, later today, next week, next year? Well, wouldn't investing be easy if we knew the answers to these seemingly simple questions? But to be honest, I don't have a Ouija board. I don't have a crystal ball. And anybody who tells you they do is full of it. There is no secret weapon outside of knowledge. There's no hidden talent outside of gaining skill and learning to read the markets. There's no easy way to do this without putting in the effort. So if you're attending this class in the hopes that technical analysis has the answers to these questions, I'm afraid I got to disappoint you. However, if you're attending this webinar with the hopes that technical analysis will improve your investing, then I have very good news for you. It surely will. But ultimately, reading price action and understanding risk management is what's going to make you a successful trader. So let's start demystifying the displaced moving average. Now, before we can talk about displaced moving averages, you have to understand what moving averages are. An important step when evaluating a trading or plan or method is to comb through the tools currently employed by a trader to determine exactly what the new approach might bring to the table. And what we're going to be looking at today is a completely new approach to one of the most well-established, well-used indicators that we currently use. Now, I'm going to use my favorite guy, Bob, as an example today. So to illustrate the process of finding the right tools, we'll use the experience of one of my clients, Bob, who was looking for technical trading tools that were easy to use, did not require intraday monitoring, and could help him become a successful trader. We're not talking about scanners. We're not talking about strategy. We're talking about simple tools. He wants to, Bob's still willing to do the work. Now, Bob is market savvy, but was tired of using the same indicators that everyone else had been using for years. And he wanted something unique that might give him a competitive edge, that might help him interpret the markets a little bit better. While there are hundreds of methods, indicators and strategies out there by the thousands, my findings on one approach might help you identify other tools. So in Bob's case, he has been using moving averages in various durations. However, Bob's moving averages weren't working out so well. Now, this is where we got to stop and talk about what moving averages are. Now, while moving averages filter out random noise in price data by smoothing price fluctuations due to its construction, this technical indicator lags behind the market and therefore will always be late in forecasting a change. So let's look at a short presentation I put together for you on moving averages, because we got to get past the general understanding of moving averages to talk about displaced moving averages and how to add them into your trading strategy. So let's take a look at this quick little presentation that'll show you all the types of moving averages and what they are. And then we'll move
to identify the direction of a trend, how they can be used to enter and exit a trade, and finally, how to trade moving average crossovers. To determine the direction of a trend using a moving average, you must take into account the set time period. We touched on this briefly in the last video where we showed you the most commonly used time periods when analysing short-term, mid-term and long-term trends. But why is it important to be aware of the time period of the moving average? In this chart, when we place a 20-period simple moving average by clicking the indicator icon and setting the time period to 20, we can clearly see that it indicates an uptrend. Yet when we place a 60-period simple moving average in the same way, we see that it shows the price in a range with no clear upward or downward trend. The difference in the direction of the trend portrayed by the moving average is due to the time period. Shorter period moving averages are faster at generating signals, and changes in the price of the instrument will be reflected more quickly. The longer period moving average will react to price changes much more slowly, but will generally provide more reliable trading signals. As a trader, moving averages will help you decide which way to trade by looking at whether the price is above or below the moving average line. In this chart, the price is above the moving average line and acts as support. You could buy and enter a long position when the price pulls back to the moving average line. You could then place your stop loss underneath the moving average. Here we can see the opposite. The price is below the moving average and acts as resistance. You could then enter a sell order when the price retraces to the moving average line and place your stop loss above the moving average. The interesting thing about moving averages is that they can be used alone or in combination with other moving averages. So when you place two moving averages on one chart with different periods reflecting a short-term and a longer-term trend in price, you have the opportunity to trade moving average crossovers. They can be used to determine when a trend has changed direction. Let's show you what we mean. On a daily chart for the pound US dollar, we will now place a 10-period simple moving average and a 20-period simple moving average. When a shorter period moving average crosses above a longer period moving average, it can signal that the trend is changing direction to the upside and it may be a good time to buy. When a shorter period moving average crosses below a longer period moving average, this is considered bearish, a signal that the trend may be changing towards the downside and it may be a good time to sell. No matter which two time periods you use, this principle will remain the same. To recap, a moving average is a lagging indicator that can help filter out the noise from random price movements to see the average value. It can help identify the trend direction, determine support and resistance levels, and can help confirm a trend reversal when looking at moving average crossovers.
So if you notice, we mentioned over and over and over the word lagging. And this is very, very important. And this is one of the reasons we come to using displaced moving averages. But this means that buy and sell signals based on moving averages occur after the trend has already changed direction. While traders are able to show profits on paper using lagging indicators, such as moving averages, my experience suggests that a several-day lag can be very costly and even devastating in real trading due to the stress of weathering the late signals and spreads and market distortions. Now, the crossover strategy, as we showed you in the video, is quite common. It's used by lots of traders, and then it's been used into developing things like MACD, which are all parts of derivatives using moving averages. A typical moving average that attempts to overcome the lag is the displaced moving average. Because what happens is ordinarily when computing moving averages and using them in some sort of crossover oscillator approach, you tend to have lag. And let's explain what lag is. Now, in the financial markets, we have the words leading and lagging. In real world, when we hear the words leading, we think it's a great thing. We hear the word lagging, we think it's a negative thing. Not in the financial markets. Leading means that the indicator is predicting the end of a trend or an end of a movement, and a lagging indicator confirms that that trend or that change has already taken place, but just taken place. Now, if you stop to think about a moving average, how do we calculate a moving average? Well, if we're using a 10-period moving average, we're using the last 10, say, closes, adding them together and dividing by 10. Well, if we have to use the last close of the last candle, the last time frame, that time frame's already happened. So we're already using old numbers to calculate, to project the forward moving. So what's happening is it's already behind because you can't calculate from the future candle. Okay. So a moving average is always lagging. But we now have the ability, which we've always had, but it was very complicated when we were doing things by hand, or even when we had the first charts, computerized charts, because we didn't have these HTML and Java charts that allow us to do some very unique things. So displacing moving averages doesn't change the formula, doesn't change the calculation. What it does is we displace or replace where we're actually putting that number, that moving average on our chart. So in other words, a simple moving average would be calculated here, because that's the calculation of that last candle, and you would put the number on your chart. A displaced moving average just simply means if you've taken a 5-period displacement, you put that number 5 candlesticks forward into the future. So let me try to show you this on a real chart. So hold on a second, let me pop up a chart. Now, what we're looking at is the Euro US dollar. This is my teaching chart. We're not here to discuss the Euro US dollar or talk about what we expect in the market. I teach all my classes using the Euro US dollar chart. Now, on this chart, I've placed a 10-period simple moving average, and that's the blue line. And as you can see, this blue line is placed right here and is using this close of this candlestick to do its calculations. So it's not helping us into the future because it's only telling us where it is using this candle as its calculations. Now, moving averages are fairly helpful in many ways. We have what we call red light, green light, where you only would take a long trade if the price was above the moving average. You would only take a short trade if the price was below a moving average. It keeps you on the right side of the trend. We also have the crossover strategy. We have lots of ways we want to use this simple line. Now, over time, traders have developed what we call the EMA, the exponential moving average. We also have weighted moving averages. Both of these types of moving averages are attempts to move the moving average or reduce the lag time in the moving average. So the EMA is a little bit more complex calculation, which gives more weight to the most current price. So it takes in consideration the move of the current price and gives extra validity to it. So as you can see here on the chart, that's the gold line. And we can see that this gold line kind of follows the shadow of the red line, the blue line, but is slightly moved forward. And this is using an exponential moving average. Okay. Same period, same everything, just a little bit more complex calculation, trying to get rid of the lag time. Now, we've tried with our new charts to add something else on, because all we're trying to do is we're not changing any of the calculations. We're just getting rid of trying to get rid of our lag time. So I'm going to go on here and add another moving average. And I'm going to add on another exponential moving average. Now I'm going to change the colors of those, and we'll make one green since we don't have green on the chart, and we'll make one got to find a color that'll stand out. We'll make one purple. Now they're going to pretty much overlap the moving averages that are there because they're the same calculations. Now for right now, I'm going to turn off the EMAs. Oh, actually, I shifted the period. So let's go back and make them 10 time periods. Let's see, now you're only seeing the two lines because all the numbers are exactly the same. So I'm going to turn off right now the EMA. We're going to stick with only the MA, which is a simple moving average. So right now we're seeing that as a purple line. Okay. Behind it, we have the other one, the gold one, which is also the moving average, same period, same everything. But I'm going to take the purple one that we just added to our charts, and I'm going to displace it. Means I'm going to push it forward on my chart 5 time frames. So what's happened is I'm using the same exact number as the gold line, but instead of putting it on the chart here, I put that same number, but I put it at 5 periods forward and put it here. And what I'm doing is now using the moving average to predict what's going to happen in the future. So we've done away with the lag. But the problem is, not the problem, the question is, by pushing it forward and getting rid of the lag and making it a leading indicator from a lagging indicator, is it still a respectable, reliable indicator? So that we're going to go talk about. Now, you can do this. I'm going to turn these off right now and turn back on the EMAs, the exponential moving averages, and we can do the same even with the EMA. We can then displace it forward. Now, what happens is when you're using these EMAs and SMAs in your other calculations like Bollinger Bands, is all based on a 20-period moving average. MACD is based on 2 moving averages. When you have them based on displaced moving averages, we get some very unusual happenings. So let's go back to my PowerPoint and let's talk about this. Now, I know some of this might be confusing because some of you may not have the basics of the moving averages. So if you look on your screen, you'll see 2 handouts I put together for you. One is the Introduction to Technical Analysis from Investing.com. This is an exceptional resource guide. You should download it. There's no charge. There's nothing I put in. Just click the download button. And this goes over all the types of technical analysis and work as a very good resource guide for you. I've also put together for you on my own a handout called the Moving Average Guide. And it's going to go over there and explain all the different types of moving averages, all the different ways you can make them, what's the difference between a weighted and an EMA, and how you would use them and the different types of uses you would have for them so that you kind of can catch up or refresh yourself on what we've been talking about. Now, a displaced moving average is just shifted forward in time, turning it into a leading indicator. So if you shift the regular moving average on your chart to the right or the left, and these computerized charts do allow us to change them to the left. I've never tried changing anything backwards because it doesn't help me going backwards. Okay, so some people have come up with all kinds of rash theories using a minus moving average. But As you can see on this chart, on the black line is just a simple line chart with price. The gold line is the displaced moving average, and then the blue line is the regular moving average. And if you look on the chart, we can see how valuable and how well the displaced moving average performed in regards to the moving average. So regular moving average picked up smaller moves that the displaced average ignored. And that's what we want to do, is we want to ignore a lot of these little moves that are unimportant to the markets. When this is done, the lag is evident in the charts as the price market trends higher, for instance, and the moving average trails below the actual daily price. Similarly, when a market reverses abruptly and starts to trend lower, the moving average lags above the actual price and briefly may even continue to increase in value even as the market is declining. But when you use the displaced moving average, you do away with it. So as you see on this little chart, which is the same gold, blue, and black line chart that we talked about, the slow moving average tracks the displaced moving average nicely during trends. The displaced moving average still lags at certain turning points because you're not going to fully do away with any lag because nothing's going to give you 100% predictability. So the assumption behind displacing today's actual moving average values forward in time is that the future period's actual moving average that has not yet occurred will, in fact, be equal to today's moving average value. This is, of course, a very simplistic forecast of a future period's price moving average. However, it is a forecast, not just a linear extrapolation from past price data, such as you achieve by extending a support or resistance line to the right of the price. So remember, this is a mathematical calculation. It's constantly updating from the actual price, where when we're using support and resistance lines, or even trend lines, they're just straight lines that are drawn out into the future. So here you have something that's helping forecast the future, but adjusting instantly to price movement. So now more research and testing of this substitute approach needs to be done before a recommendation can be made. And I can't tell you, I've been using this for a long time. Okay, I use a 5-period displacement, but you could use a 2-period displacement. You could use a 14-period displacement. This is one of the few times that you can customize an indicator, test it for yourself to become your personal guide, your personal approach to the markets. When the predicted moving average for a future date is greater than today's actual moving average, the market can be expected to move higher throughout the time. Conversely, when the predicted moving average is less than today's actual moving average, the market is expected to move lower. The difference between the two moving averages measures the strength of the expected move. Now, this is another idea of using it. Use a 5-period displaced moving average and a non-displaced moving average and see what the two are telling you together. For example, a predicted 10-day moving average for the 4 days from today is compared to today's actual 10-day moving average. If the predicted average is greater than today's actual moving average, the market is expected to go up. When the difference reaches a maximum positive number and starts to shrink, that is an early indication that the bullish trend is starting to lose strength and that it is moving and should top out soon. Now, then if you predict average, your predicted average says cross the actual moving average from above or to below, so that is the difference between them shifts from positive to negative. So what you're doing is you're using, instead of using a 10-period and a 20-period moving average in a moving average crossover, you're using a moving average, simple moving average, and a displaced moving average. So you're just finding new approaches to analyze the market. So here on this chart, you can see that the predicted moving average, which is the blue line, clearly leads twists and turns of the actual 10-period moving average. But when we see the two together, we can then make some determinations, as when we see here the crossover between the leading and the simple moving average. More aggressive traders might even reverse positions prior to the cross actually occurring. Other more conservative traders might wait for the cross to take place before putting on a position. While it is similar in many ways to the typical moving average crossover method that we can all find familiar with by forecasting the moving averages, Bob has found a way to overcome their lag and effectively transform this popular technical indicator from a trend lagging into a trend leading indicator. So let me share with you a little presentation on using moving averages and crossovers in your strategies, and then we'll come back and talk about adapting them for your use.
I want to point out that this is something that works in all time frames, so you day traders might want to incorporate this as well. It actually works quite well for day trading as well. A lot of times I will run just a single moving average line on my chart. I tend to use a longer moving average line like a 55 or perhaps a 60, and if the market is above my moving average line, I consider it to be bullish, and below the moving average line, I consider the market to be bearish. Just a very simplified indicator to tell you what the market is doing. You can also look at the moving average line itself. If the moving average line is moving down, well, of course, the market is bearish. If the moving average line is moving sideways, and you'll be surprised how often this happens if you look for it, you'll know the market is neutral and it's a good time to avoid it. And then, of course, if the moving average line is moving higher, the market is bullish and we should be looking to buy. I also like to put a second moving average line on the chart on occasion. And my line of preference, and actually coincidentally Rob's line of preference, is also the 20 moving average line, the 20 period moving average line. This works great on a daily basis, but it has merits for an intraday basis as well. From a daily point of view, there's 20 trading days in a month, so the 20 period moving average line roughly represents the monthly trend. You can see it's a little bit more responsive. It follows prices more closely. But here's the principle I want to share with you. When prices are below both lines, then that is the time to consider a trade. If prices are above both lines, that is a time to consider a trade. However, when prices are between the lines, as they are back here, or as they are here, or as they are right here, these are the times to avoid a trade. Now, on a daily chart, these regions are rarely as large as they will be on an intraday basis. Rob even coined the phrase abattoir, which is French for slaughterhouse, because that's where a lot of traders end up getting killed. Why? Well, simply because the market has no defined direction. When prices are trading in between the moving average lines, what is that telling you? If we changed this and put, say, a 5-period moving average on here as well, let me see if I can delete the... Okay, here's your chart without any bars on it, just your moving average lines. The turquoise being the 5-period, the 20 and the 55. Well, here it is in between your 20 and your 55. So what is that telling you? That's telling you you have a market that has no real direction to it. Here the market has direction. The 5 is below the 20 is below the 55. Prices are going down. Here the market has direction. The 5 is above the 20 is above the 55. The market is moving up. And likewise here, we have direction. But here, what do we have here? We have nothing. We have a jumble of information. Now, I know there's different ways that you can trade these moving average lines and such, and we're not going to get into that into this lesson. But I just wanted to show you.
So as you can see, we can use these moving averages, and when we displace them forward and add them together, we get a little bit more predictability but with some future indications. Now, let's continue talking about Bob though. Rather than, because now we want to go see how we can use these for stop loss and maybe entry points. So remember we were talking about Bob and he wants to come up with a new trading style. So rather than using fixed dollar stops, Bob can use these high and low predictions, for instance. The predicted high and low range can be used on subsequent days to move his trailing stops. So if Bob is long the euro and based on the forecast, the target market is expected to continue to rise, he might set his stop a few ticks below the predicted low to act as the support level. Traditional support and resistance trend lines tend to be used by too many traders, and their stops often are bunched together and frequently get hit. Using a predicted high or low to set stop losses may lessen the likelihood of being stopped out during intraday trading. So when you're using a displaced moving average and putting it forward, and you get a crossover or a break of the moving average, you're in the future. So then you can adjust your stop loss before it reaches that point. So the predicted high and low reliability bracket for the actual high and low of the following trading day provide good guidance for stop placements. So it's unrealistic to expect any indicator, regardless of its construction, to be able to tell you what the future trend direction of a market will be with complete accuracy. The Holy Grail has yet to be found because it just doesn't exist. There's no magic bullet, but a lot of research, hard work, and lessons learned can help form and help avoid common pitfalls and gain the competitive edge. So how do you recognize which displaced moving average you need? Well, the answer to that question is quite simple. Trial and error. This is one of those things that there is no guideline. There is no set of rules. There's nobody 100 years of trading that's telling you to use a strat. Now, you're going to find gurus in the market that'll tell you exactly what to do. But forget that. This is one of those strategies that you can easily customize, test it for yourself, and make yourself a better trader than the guy sitting next to you or the guy across town. So you always want to confirm and check what you're doing. You always want to adapt. So how can you adapt the displaced moving average into your indicator? Well, we are going through 3 suggestions how the DMA can be combined with other trading indicators. 1, we can combine it with simple moving averages. By simply using a displaced and a moving average of the same time frame, we can combine them together to get a crossover strategy. 2, we can combine a positive and a negative displaced moving average with the same period. And again, I told you I don't believe in these negative things, but you could use a 3-period displaced moving average and a 7-period moving average, displaced moving average, and get them to cross over, and then combine them with a simple moving average and look for how the 3 moving averages fan out, or when they give you those no trade zones and trade zone above and trade zone below. And the last is taking displaced moving average and a simple moving average and adding it with stochastics and RSI to have a very complex system. Here we are using the oscillator to determine trade opportunities as a result of crossovers of the moving averages. This is by far the busiest of the strategies mentioned. You will need to determine if so many indicators on the chart create sensory overload for you. They sure do for me. We close our position whenever the RSI goes to the other extremes or whenever the moving average crosses one another. I believe in strategies to be simple. All I want is something to give me an indication that I could go long or go short, or I should exit the market. Then I want to apply my risk management skills and then just determine if I want to make that trade. So Our use of displaced moving averages as part of a trading strategy has a few uses. It can be used to give us a bias in regards to the direction we can take a trade. It can be used as a trigger into a trade in the direction of a bias, and can also be used as a setup indicator. You have to admit that something so simple as a moving average can have very wide ranges of uses. So Bob continued to use this and build it into his entire own trading strategy. We can get a lot of information to form the basis of a trading strategy by looking at the charts. The secret is to use a higher time frame as your bias for a trade direction and a lower one for your actual trading. So there is a lag, like all trading indicators, and the displaced value gives a little bit more, gives us a little bit less lag. Using the slope of a channel and or a trend can help us outsmart the markets. My opinion is that you want all of your Forex trading strategy to be as simple as possible. This will allow your method to be a lot more adaptive to different market conditions. One thing about displaced moving average strategy is that it is fairly objective. It's easy to combine, it's easy to understand, and it's easy to adjust into your charts. So the question is, are displaced moving averages a good trading strategy? So this is a simple strategy, especially if you're swing trade markets like Forex. It's got clear entries, trading signals, which many traders have problems with. I think the displaced moving average is a great strategy to add into your trading. Displacing a moving average involves shifting it just to the left or the right by a certain number of time frames. So summing up what we observed, displaced moving average is effectively a slower moving average with increased lag at turning points. We cannot reproduce a displaced moving average simply by adjusting the period of moving averages. However, the displaced moving average is not a mystical forecasting tool simply because we displace it to the right in the future. So in summary, the displaced moving average is a great way to adjust a regular simple moving average to fit a trend line. It has the same function as a regular moving average to determine support and resistance. If a moving average is displaced with a negative value, it is shifted to the left and it is lagging. If the moving average is placed with a positive value, it is shifted to the right and becomes leading. Trial and error is the way to discover the right displaced moving average for you. Displaced moving average can be combined with other trading instruments to clarify signals, like relative strength index, chart patterns, candlestick patterns, stochastic oscillators, simple moving averages, momentum indicators. The DMA does all the things a normal moving average does, but in some cases, it may do it better because it can be better tailored to the asset being traded. In general, the DMA helps determine trend direction. When the price is above the MA, that helps indicate an uptrend, or at least the price is above the average. When the price is below the MA, the price is below the average, which is one sign of a downtrend. When the price moves through the MA, this could signal the trend is changing. If the price falls through the MA from above, this could signal the uptrend is over. How the MA is displaced can aid you in providing better reversal signals. Assume that in the past, the uptrending price has just slightly dropped below the MA, only to rally once again shortly after. In this case, the price dropping below the MA wasn't a reversal signal. The MA just didn't fit the price action. Displacing the moving average by several periods may help keep the price above the MA, creating a better fit for the asset's trend. So an MA is the average price of an asset over a period of time. It does not inherently have any predictive calculations factored into it. Therefore, any MA, including a displaced one, won't always provide you reliable information for trend reversals or support and resistance levels, but it might help you understand what the market is going to do moving forward. And on that note, I'm going to say goodbye to everybody. I hope you learned a little bit about a new use of an old indicator, and try it out. You'd be surprised how well it works. And personalize it, understand it, and make yourself better than the guy next to you. Bye now.